Hello there, students of economics. Welcome to this teaching module. I wonder if you heard this song. Money, money, money is not funny in a rich man's world. Well, if you go on and listen to the song, there's much more about money. But one thing's for sure, money is not just a part of a rich man's world. It is a part of everyone's life. We need money to carry out various purchases. We like to invest money. We like to save money. So let's learn about money and banking. Before we move on with the topic, let's have a brief overview of what we're going to study. We're going to study about the functions of money, the motives of holding money, the measurements of money supply, the primary functions of commercial banks, and the types of deposits with commercial banks. So let's learn something new today, okay? Stay with me. It is imperative for us at this point to delve and talk a little about the evolution of money. We know that initially when goods needed to be shared or exchanged, there wasn't any money or a medium of exchange or a mode of payment. So people exchanged goods for goods. That system was called the barter system or the barter economy, also known as the commodity for commodity economy. So it began with the barter system. But there were some difficulties with the barter system. And so to overcome those difficulties, society invented money. This happened because of the increasing scale of exchanges that needed to be taking place. So like man, money also evolved. You can see initially goods were exchanged for goods. But then it was a problem because there had to be double coincidence of wants if an exchange was going to take place. Then money evolved into, say for example, shells or leather, pearls, precious stones, even salt. That was called as commodity money. Then we had metallic money. Commodity money was replaced by metallic money. This happened because of the growth of human civilization. So the medium of exchange were metals, particularly gold and silver. Then we had paper money. It was inconvenient to use gold and silver. And so paper money helped huge transactions which require the use of money. Then of course came credit money or bank money. We also call it as plastic money in the form of debit and credit cards, which is used as a medium of exchange. Today we have digital exchanges of money or digital payments are made. Money has even evolved into something known as cryptocurrency, which is yet to be legalized. So this is how money evolved over the years. Having looked at how money evolved way back from the barter system into the present day modern money system, we must now look at what are the functions that money serves. And there's a small little poem for you to help you to remember the functions of money. Money is a matter of functions for a medium, a measure, a standard, a store. So what are the functions of money? Money is a medium of exchange. It is a measure of or unit of value. It is a standard of deferred payments. It serves the function of store of value. And it also serves the function of transfer of value. Let us look at the first function of money, and that is medium of exchange. This means that money acts as a medium of sale and purchase of goods and services. Introduction of money has separated the acts of sale and purchase. Double coincidence of wants, as was the case in the barter system, is not required as a result of overall economic activity having risen. Production is market-oriented, not subsistence-oriented like it was in the barter system. Now, what do we mean by double coincidence of wants? It means that if I want to exchange a good with somebody, they should have what I want and I should have what they want at the same time. And then only an exchange was going to take place. But now, with the money system, that doesn't have to happen. I can exchange goods in terms of money. So money is the mode of payment or medium of exchange. The second function of money is a measure or unit of value. What does this mean? This means that the value of each good and service is measured in terms of money. This was absent in the barter system, as there was no common unit of measure or no common unit of value. Since the value or price of good is now expressed in terms of money, accounting is now simple and easy. So all we have to do is express the worth or value of goods in terms of money. So money serves a purpose of expressing value of goods. The third function of money is it is a standard of deferred, or in other words, delayed payments. Now in the barter system, if you were to borrow something from someone, how would you pay back? How much more would you have to give the person back? There was nothing to express this. But money has made making deferred or delayed payments, which are to be made in the future, easier. Now, when money is borrowed, the principal amount and the interest can be paid. We can express the interest in terms of percentage. And so a percentage of the principal will have to be paid after the loan is to be repaid. It was difficult to make such payments in the barter system. For example, if wheat was borrowed, it was difficult to determine how much is to be paid back or how much more is to be paid back. Now that problem is resolved because we have money. The fourth function of money is it is a store of value. Money helps to store value or wealth, which is a source of future investment. Now in the barter system, because goods would perish and wear out, this was very difficult. Storing goods for long periods, perishables, was difficult. Now money has general acceptability. Its value remains relatively stable and its storage does not need much space. So therefore we call this function the asset function of money. So we can save money for our future, maybe to build a house, for medical expenses, college or education of children, to go for a vacation in the future, or whatever other expenses or expenditures might be there. The fifth function of money is transfer of value. Goods nowadays are purchased from distant places, both for consumption as well as for investment. Purchasing power is needed at those places. So transfer of purchasing power from the place of residence is needed. Money acts as a mode of transfer value from one place to another. No longer we have to be present at the place where we want to purchase something from. It can be made digitally via credit or debit cards even. Having studied the functions of money, we have to now look at what are the motives of holding money, and that too in the form of cash. So the demand or desire for money is sometimes called liquidity preference. People desire to hold money balances or cash balances for the following motives. The first motive being the transaction motive or transactionary motive. the precautionary motive and the speculative motive. We will take each one separately. What is the transaction motive? People demand money in cash or liquid form in order to meet their day-to-day transactions or expenditures. A firm or an individual receives income at a fixed period of time, right? Somewhere at the end of the month or the beginning of the next month. But spending is spread over a period of time. In order to meet these expenses, money in cash is needed. The amount of money an individual needs for this motive, to fulfill this motive, depends on his income or his purchasing power. This motive does not depend on the current interest rates. Next, we have the transactionary motive. Individuals and firms demand money in cash form. Why? Sometimes to meet any unforeseen circumstances or contingencies like illness, unemployment, accidents, and so on that may arise in an individual's life. Thus, liquidity preference or desire to hold money in the form of cash exists for unexpected events, and this contributes to precautionary motive. The amount of money people hold for this motive depends on the income of the person or individual. It does not depend on the interest rates. The third motive is the speculative motive. This is very important. So listen carefully. Traders and businessmen make estimates about the future prices of bonds in order to make profits. This motive of holding money in cash is related to the present rate of interest. For example, if the bond prices are low and the interest rates are high, then traders and businessmen who are interested in investing in bonds will want to hold money in cash so that they can take advantage of the low prices of bonds and the high rates of interest. If the rate of interest on bonds is low at present but is expected to rise in the future, people holding bonds now anticipate a capital loss and want to hold cash. But if the rate of interest is high at present and expected to fall in the future, bondholders anticipate capital gains and will not prefer to hold cash. In order to know how much is the money supply in the economy, there are measures or measurements of money supply. In India, there are 4 alternative measures of money supply. They are called as M1, M2, M3 and M4. Let's look at the first measurement of money supply, and that is M1. M1 measurement of money supply is equal to the sum of currency notes and coins in circulation with the public, demand deposits of the people with commercial banks, and other deposits, that is, demand deposits of public financial institutions like IDBI, foreign governments and banks, and of the international financial institutions like IMF and World Bank with the RBI. So M1 is equal to C plus DD plus OD. The next is the M2 measurement of money supply. Along with M1, it includes savings of the people with post offices. We know that people save money in post offices, right? So the economy might also want to know what is the sum of M1 and the deposits that people have in post office savings bank accounts. So M2 is equal to M1, which is C plus DD plus OD, and the deposits with post office savings bank accounts. Then we have the third measurement of money supply, which is called as M3. Now M3 along with M1 includes net time deposits, or what we call as fixed deposits, of the people with commercial banks. So M3 is equal to M1 plus fixed deposits with commercial banks. Now moving on to the M4 measurement. Now M4 measurement along with M3, it includes the total deposits with post offices other than national savings certificates, what are known as NSCs. So M4 is equal to M3 plus total deposits with post offices but not including NSCs. So all deposits of the post offices will be added to M3 to give us M4 with the exception of NSCs. And so to sum up, we have the M1 measurement, which is equal to currency plus demand deposits plus other deposits of RBI. M2, which is equal to M1 plus savings deposits only of the people with post office saving banks. Then we have M3, which is equal to M1 plus time deposits with the commercial banks. And lastly, we have M4, which is equal to M3 plus total deposits of post office savings organizations, excluding NSCs. Now let's move on to the banking side of this chapter. So it is imperative for us to understand the most important part of the banking system, which are commercial banks. What is a commercial bank? A commercial bank is that financial institution which accepts deposits from the people. At the same time, it offers loans for the purpose of consumption or investment. Here we have a definition of commercial banks, quote unquote. Banking company is one which transacts the business of banking, which means the accepting of deposits of money from the public, repayable on demand or otherwise, and withdrawable by check, draft, order or otherwise. Let us now study the functions of commercial banks. Well, the most important functions of commercial banks are accepting deposits and advancing loans. So here we're going to look at the first function, that is accepting deposits. A bank accepts deposits from the public. People can deposit their cash balances as checkable deposits, which are those against which checks can be issued and therefore money can be withdrawn anytime. They can also deposit their cash balances as non-checkable deposits, which are those against which checks cannot be issued and therefore money cannot be withdrawn anytime. Instead, money in these deposits is kept as reserved with the bank for some fixed period of time. So we call these deposits fixed deposits. The second most important function of commercial banks is advancing loans. Banks advance loans mostly for productive purposes, and it is always done against some approved security, and this security could be a property, an asset, which the bank calls as collateral. The amount of loan is generally less than the value of this collateral or security. It is important to note that the loan amount is never paid in cash. All loans are reflected as demand deposits with the banks. Now we know that all deposits are not withdrawn at the same time. So banks keep as cash reserves only a small percentage of the total demand deposits. They don't have to keep everything in the form of cash because everyone is not going to go and withdraw all their cash reserves at one time. So banks can keep a small proportion of their total deposits in the form of cash. And so what do they do with the rest of the money, which they don't keep in cash form? Accordingly, loans are offered many times more than cash reserves of the banks. This is how banks create credit. And this is how they add to the supply of money in the economy. Having studied the functions of the commercial banks, now let us look at the types of deposits that are offered by commercial banks. The first one is the current account deposit. Now here they are payable on demand and can be withdrawn upon by check without any restriction. These account deposits are held by businessmen. These are the ones who use this account. No interest is offered on these deposits. Next we have the savings account deposit. These are payable on demand and withdrawable by check. Of course, interest is given, but it is less than the rate of interest that is offered on fixed deposits. Who holds these deposits? Households and firms. They use this account. The third type of deposits is fixed deposits, also known as time deposits. Here, the customer deposits a certain sum of money for a fixed period, which is not withdrawable before the maturity date. He gets interest on the deposits for that time period. The rate of interest charged on these deposits is normally higher than that allowed on savings deposits, so that people are attracted to save their money for longer periods of time. Then we have the recurring deposits. In recurring deposits, customers remit a certain amount of money on monthly installments for a period ranging from 12 to 120 months on a uniform pattern. The entire amount, along with the interest, is payable after the payment of the last installment. So here the customer will regularly deposit certain sums of money. Maybe he may give an instruction, a standing instruction to the bank to debit this certain amount of money every month from his account into the recurring deposit. So he will get this entire sum along with the rate of interest or interest that is to be paid to him when the last installment is paid by him. So today we have learnt about the functions of money, the motives of holding money in the form of cash or liquidity preference. We learnt about the 4 measures of money supply. We learnt about the primary or most important functions of commercial banks. And we also looked at the types of deposits with commercial banks. Thank you, students, for giving me a patient listening ear.